Hello and welcome to San Diego Market Watch, where we bring you accurate, timely information about the real estate market in San Diego County. Today is February 16th, 2023. 6 weeks into the new year, halfway through the first quarter of 2023, and the real estate market in San Diego has not so far behaved as many had predicted and most had expected. In fact, it has been just the opposite. As we look at homes for sale, which is always the first thing that we look at here on San Diego Market Watch, as you can see, it has been in decline for so long that our entire graph here is now showing the decline. We no longer see this line that went out here up at the 4,500 unit mark into eternity. Pretty much from June until mid-November, we were up here around 4,500 units, and now it has gone down here below 2,400 units, or I'm sorry, below 2,500 units. I don't want to freak anybody out there, but we did have to add a different scale to our graph here just to represent the decline in homes for sale. It really has been dramatic. Now, of course, at the beginning of 2022, we had even less homes for sale. It was down around 1,400, even below 1,400. So this number is not the lowest we've seen by any stretch, but certainly nowhere near the highs that we were seeing, last summer. And, just for reference, if you go back to the 2009, 2010 timeframe, we had around 10,000 units on the market. So inventory is very, very low, and that is driving prices to, remain stable and possibly even be pushing upward a little bit. We'll talk about that in a second. Back here in the middle of January, we saw the number of pending sales cross above the number of new listings, and it has stayed there. We had a jump in pending sales last week, the week before last, and then a decline, which appears to be a sharp decline just in the past 1 week. However, with less homes for sale and this data scale being so compressed here, that sharp decline is really not that dramatic as it might look. But in any event, we saw the number of pendings jump the same week that we saw a number of new listings jump, and now we see pending sales declining as we see new listings declining. Now this pending sale graph is heading back toward the number of new listings in this graph here. So is this going to dip below and cross back over this again? If so, that could spell a little bit of concern for prices in terms of remaining stable or rising. If demand falls below new supply, that could change the dynamic here. And then with regard to closed sales, slightly down from last week, but we have been seeing an increase, a steady increase in closed sales since the middle of January, which reflects the rise in pending sales that we saw, back here in late December. We're starting to see these properties close over here now. So I would expect to see closed sales begin to trend upward again, and you might even see some stories in the local media about a tremendous rebound in closed sales. The one thing you have to remember when you're reading these media reports is they typically will pick one of these four dynamics and just hyper focus in on that to create a sensational headline. If I wanted to create a sensational headline about this broadcast, I could say that San Diego home inventory has plummeted, which, it has. At the same time, I could say that there's been a dramatic increase in pending sales or a dramatic decrease in pending sales. However, none of these individual metrics mean much in a vacuum. You really have to look at all these things together to figure out what the market is doing. And at the moment, it does appear that these three lines are heading for a convergence. That'll be interesting to see what happens there. I do expect to see closed sales jumping up, so we will see what happens to new listings and whether this decline in pending sales is something that continues or whether that's just, what happened last week. So moving on to interest rates, those are up slightly from the week before. Rates were very kind of steady, right around 6%. And now on average, we're looking at 6.32 for the 30-year fixed. We do expect rates to remain in this sort of, 6.25 or 6.3 to, down to maybe 5.8, 5.9. They should remain in this general area here, excuse me, and not be as volatile as they were last summer and last fall. That is at least the prediction from mortgage industry experts, that we're going to see less volatility in rates and a trend towards decreasing rates. Now, if that is not accurate and rates continue to increase, that could change things dramatically. Goldman Sachs, of course, has predicted that San Diego is one of the housing markets that will experience a 2008 style crash in 2023. And this is coming from one of the outfits that brought you the 2008 style crash in 2008. Goldman Sachs was one of the leading offenders in bad mortgage investments and one of the leading recipients of the billions and billions of dollars in federal bailout that was given to banks and financial institutions back in the 2008-2009 timeframe. So what they are basing that prediction upon, I really don't know. They say that we are one of the most overpriced markets, and I personally don't see that, as we see influx of new jobs and companies, high-tech and biotech companies expanding in San Diego, creating more high-paying jobs. Yes, homes are priced high in San Diego, as they are all over Southern and Northern California. So I really can't tell you why Goldman Sachs says we are heading for a 2008 style housing market collapse here in 23. We definitely don't have tons or any really bad mortgages on the books. Foreclosures are at record lows, unemployment at record lows. So I guess we'll see. This interest rate situation here, could be a primary driver for a price collapse if this were to shoot back up here, into the sevens again. This was bad. If we can keep it where it is now, and this might actually be a prime reason for the drop in pending sales last week. We had average interest rate increase a little bit. That might cause buyers to, back off and wait a week and see what happens. So anyway, I think this number is far more responsible for the direction of the real estate market than anything else. That and supply. Supply is always going to be very important. Supply and demand, of course, very important in economics. And the demand will drop if the supply, or the demand will drop if the rates rise, and if demand drops, supply will likely increase. So that's what's happening with rates and inventory. Now let's take a look quickly at median price. And as I have been talking about for the last several weeks, I expected to see, after this downward trend, and then we had a reduction in the downward trend between November and December, and then between December and January, and then between November, December, and January, we actually saw a very modest uptick in median price, and it was modest enough, I believe 0.3% increase, to really say that it's leveled. We saw it coming down quite dramatically, a little bit of an uptick back here in the late summer, and then continuing to decline into the fall. And then as mid-November, December definitely started to level out, and slight uptick last month. We'll see what happens from January to February when the February numbers come out next month. I expect to see probably a more larger increase than we saw December to January at 0.3%. We may even see a full percentage point increase in median price, or somewhere in that range. So I do expect this to tick up a little bit next time. We will see. So if you like this content, if you're enjoying this program, please like, share, subscribe, and comment. Hit that like button at least. We really love new subscribers, and we love your comments. Always respond to comments and take those very seriously. So go ahead, like, share, subscribe, and comment, and that'll help us to keep bringing you this content. So with that, I will say good day and have a great weekend. We'll be back next week with more neighborhood real estate update and another edition of San Diego Market Watch. Have a good one, everyone.